All right, let's pull back the curtain on the language of the financial markets. Welcome, everyone. Today, we are going to decode the trading glossary once and for all.
So, have you ever been watching the news or scrolling online and you hear these terms, algorithmic trading, bull market, short squeeze, and you just kind of nod along? If that language of Wall Street has ever made your head spin, well, you are in exactly the right place.
And trust me, you are absolutely not alone. The world of finance, it really has its own language, but that's what we're here for. We're going to take a little journey together, starting with the absolute basics and going all the way to the high-tech edge of today's markets.
Okay, so first things first. Every field has its own lingo, and if you want to navigate the markets, you got to learn to speak the language. So let's start with the absolute fundamentals.
First up, the bid price. Let's say you own a share of a company. That's a security, and you want to sell it, like right now. The bid price is the highest offer on the table from someone ready to buy it from you. It's your instant sell button price.
And on the flip side of that coin, you've got the ask price. Now, imagine you want to buy that same share instantly. The ask price is the lowest price any seller out there is willing to take. So to buy it now, you have to meet their ask.
So you've got the bid and you've got the ask. That little gap in between the two, that's called the spread. Think of it as a small, built-in cost for making a trade. And here's the tip. A really tight, small spread usually means the market is super liquid. Lots of buyers and sellers, making it easy to get in and out.
These two. You've definitely heard these on the news. Here's the easiest way to remember it forever. A bull thrusts its horns up, so a bull market is one where prices are rising and everyone's feeling optimistic. A bear swipes its claws down, so a bear market is when prices are falling and pessimism takes over. Bull up, bear down. Simple as that.
All right, now that we've got some of the basic language down, let's see how people actually use it. In the trading world, you'll find there are really two main schools of thought, two completely different paths people take to make decisions.
And this is really the great divide in the trading world. On one side, you have fundamental analysis. Think of these folks as detectives. They're digging into a company's health, its earnings, its management, trying to figure out why it's valuable. On the other side, you have technical analysis. These are the chartists. They don't care as much about the why. They're studying price history and patterns to figure out what the price might do next and when. So what's a fundamental analyst actually looking at? Well, they're poring over financial reports. They're looking at things like the PE ratio to see if a stock is cheap or expensive compared to its earnings. They're checking the company's debt levels. And ultimately, they're searching for what's called an economic moat. That's a company's big, sustainable advantage over its competitors.
Technicians, meanwhile, live and breathe their charts. They're using tools like moving averages to smooth out all the noise and see the real trend. They're looking for special candlestick patterns that hint at where the price might go. And they are always on the hunt for support and resistance levels. Think of them as invisible floors and ceilings that the price tends to bounce off of. So you've picked a philosophy, fundamental or technical. Great. But how do you actually put your ideas to work? Well, for that, you're going to need a specific set of tools to execute your plan in the real world.
And one of the most powerful tools out there is leverage. But let me tell you, it is a classic double-edged sword. It's basically using borrowed money to control a position that's way bigger than what your own cash could handle. And yeah, it can magnify your profits, but it will also magnify your losses by the exact same amount. You have to handle this one with serious respect.
And because of tools like leverage, real professional trading isn't just about picking winners. It's actually all about risk management. It's the art of protecting your money. This means figuring out your position size, how much you're willing to bet on one idea, and using safety nets like a stop-loss order, which is an automatic command to sell if a trade goes against you by a certain amount. It's your escape hatch. Now, when it's time to actually place a trade, you have a crucial choice. A market order basically screams, "Get me in right now. I don't care about the exact price. Just fill my order." So it guarantees you get the trade done. A limit order, on the other hand, is much more picky. It says, "I will only buy at this price or lower, or sell at this price or higher." It guarantees your price, but there's no guarantee your order will ever get filled. Okay, now we're going to pivot from the classic human-driven world into the modern era. We're talking about a world that is now dominated by incredible speed, massive amounts of data, and powerful computer algorithms. Welcome to the rise of the machines. So, at its heart, algorithmic trading, or just algo trading, is pretty simple. It's using a computer program to follow a very strict set of rules. You tell the program when to trade, at what price, and how much, and it does it all automatically. The big idea is to take human emotion completely out of the equation. And what do these algos do? All sorts of incredible things. You have high-frequency trading, or HFT, which executes millions of trades at speeds we can't even comprehend. You have arbitrage bots that hunt for tiny, fleeting price differences between different exchanges and profit from them instantly. And many are just market makers, constantly placing buy and sell orders to keep the markets running smoothly for everyone else. Now, a lot of this high-level action doesn't even happen on the public stock exchange. It happens in places called dark pools. Sounds a little mysterious, right? They're basically private trading venues where huge institutions like pension funds can buy or sell enormous blocks of stock without tipping off the rest of the market and causing the price to move against them. But, for all this talk about supercomputers and algorithms that trade in microseconds, we've come to our final and maybe the most important section. Because no matter how fast the tech gets, trading always comes back to the human mind.
So let's meet the two great puppet masters of the market, greed and fear. Greed is that little voice that tells you to hold on to a winning trade way too long, hoping it'll just go up forever. And fear is what causes you to panic and sell everything at the absolute worst possible time. I'd argue that nearly every mistake a trader makes can be traced back to one of these two emotions.
In fact, this is so important, there's an entire field of study called behavioral finance. It's a fascinating mix of psychology and economics that tries to figure out exactly why we humans so often make completely irrational decisions when it comes to our money. And this field has identified some really common psychological traps we all fall into. There's FOMO, the fear of missing out that makes us chase a stock that's already gone way up. There's loss aversion, this weird quirk where the pain of losing $100 feels way worse than the pleasure of gaining $100. And of course, there's confirmation bias, our natural tendency to only look for information that agrees with what we already think. So all of this brings us to one final thought. We live in an age of artificial intelligence, of markets that are smarter and faster than ever before. But if those incredible systems are still built by and overseen by humans who are wired with fear, greed, and all these biases, well, maybe the final frontier isn't about conquering the market. Maybe it's about conquering ourselves.